Hi, welcome to It's Your Smarter Money with Dr. Laura and Professor Steve. Today to talk to you about a topic that we are going to continue to talk about forever because we think that clients will really benefit from this conversation. You know, market timing, attempting to buy and sell stocks, or even trying to make tactical asset allocations exactly at the right time presents a tremendous challenge. First and foremost, you should keep in mind that markets are fiercely competitive and they're very adept at processing all the information that's out there. So by the time you've seen something on TV, chances are all that information is already reflected in the prices that stocks are currently trading at. So just in general, it's not a good idea to try to think that you can second guess the market.
No, it's even hard to time inefficient markets because so much of it's based on world events and other things that are very difficult to predict. Just like nobody could predict COVID. I think even 2 weeks ago, nobody was exactly sure that Putin was going to invade the Ukraine, for example. So
there's a ton of variables, right, Steve? I mean, you really need to do a multivariate analysis with thousands of different variables to be able to determine where the market is going. And still, people have tried to do that, and they're unsuccessful.
They are. So here, I think, Laura, you put together a slide that shows some of the major declines over the last, I guess, 35 years or so, right?
Yes.
And it's sort of ranked here by the largest decline in the markets over 1 day. And you see the largest was in 1987, where there was actually a 1-day decline of over 20%. And there've been some steep declines over 1 day. Even the COVID-19 pandemic was 12% in 1 day, which is, that's pretty stunning. And it's almost as if the market does that purposely to try to drive out the people that shouldn't be in the market. It's kind of sounds funky, but it almost seems like that's almost what happens. But I think the interesting thing here is how many days it took afterwards for it to retake the previous high, which is quite interesting. And even in the worst crises, which we saw in terms of the market, in terms of the length, which is 2008, it took 410 days, roughly, I guess, about 16 months. I think I did the math, 15 months. So even with large declines, we typically see the market go back to its prior peak within maybe 18 months, I would say, is probably the longest I've seen.
And within the year or so, there's tremendous comeback. Oftentimes, it can come back very, very quickly, and
yes,
even a couple of months.
And we have some data later on that's going to show that in more detail. Laura, would you like to add anything else to this particular?
No, I think it's somewhat self-explanatory. I mean, most of you can see how quickly the market just completely turns back around again.
Yeah, and we see that. A lot of people call it the V-shaped recovery. The market, falls almost as if it's falling off a cliff, but then when it begins to recover, it recovers really quickly. And missing that recovery is really a big issue if you miss it. And here's, I think, further evidence that you've put together here, Laura.
Yeah, I like this particularly because it's just kind of, so you have $100 and you invested it in the market from the beginning of the century to 2020, so 20 years. If you just stayed put and did nothing, you would have actually had a 6% return over that 20 years, and you would have had $324, which is great. If you somehow decided, no, I'm going to start moving in and out of the market, this is where people start getting into trouble, because if you even missed 10 of the best days, your return pretty much more than halved. If you missed the 20 best days, you really probably broke even. And if you missed 30 of the best days, you are actually sitting with a loss. And by the way, we have people coming into our business day after day saying, can you please help us with our investment portfolio? Because this is where they are, where they actually, over the past 20 years, where we had some decent returns. People are walking in with portfolios that have been decimated over the past 20 years.
Yes, we have. And
Uh,
so, yeah, and this shows you how hard, more further information or proof that's so hard to time the market here.
We have chart after chart. I mean, we just pulled a couple of charts. This was something that I think was done by Bank of America recently, where they showed different time periods, and you can look at the different decades and see how, yeah, you know what? If I could have picked those worst days, I could have even done better. Well, good luck trying to do that. Just the whole aspect of just staying put in the market versus trying to go in and out really, really makes a difference. And, Steve, one of the things that I was thinking about that, all the data that we have that continues to show this over and over again, even if you think of this just logically from a standpoint of probability. So Steve and I
Yes.
are big on math and big on probability. And you think about the idea of market timing and the fact that you have to make the right choice going in and the right choice coming out. And okay, so if you even eliminate all the other complexities that are going on and you say, okay, I have a 50-50 chance of picking the right time to get out of the market. Okay, fine. And then I have a 50-50 chance of getting back to get into the market, assuming that these are not connected decisions, which is a bad assumption.
Yes.
But even assuming that 50% times 50% is 25%, that means that 1 out of 4 times could you possibly get it right. And that's considering the whole magic. It really gets much more complicated. And if you really took into all the other factors, it's really maybe 1 out of 1,000 that you could really get it right. And so even the math, and when you start looking at probability analysis and being able to do that, another reason why it's nearly impossible to do this.
And so I like, there's another good example I've heard, and that's if you had 100,000 people all flipping a coin, certainly 1 or 2 of them are probably going to get heads 20 times in a row. And so look at that from the aspect even of active portfolio managers. You have thousands of them out there, and some of them are going to seem like geniuses because they're those people that were lucky enough to get heads 20 times in a row. But you don't hear about the other 99.9% that didn't get heads 20 times in a row. And so suddenly they seem to be the new guru and the new investment expert. But the problem is, could you have predicted that now? Who was going to be that person that got 20 heads in a row in 20 trials? You can't predict it. And going forward, can you predict that kind of luck is going to continue? And so sometimes people get fooled by that because I've seen that too with actively managed funds where they seem to beat the market, for good 8 or 9 years in a row and consistently, and suddenly they give it all back in 1 year. We've seen that. And I think some of them are market timers. I think more of them probably these days focus on fundamentals when they try to pick stocks. And that's just as problematic in many ways. But I think those who do try to actively time the market, they're in the long run, they're not going to win. And by the way, they also increase costs. They create tax events, and that's an added drag on performance. They generally have higher expenses. And Lori, I know you have a chart later on showing the impact of expenses on performance too, and that's a drag as well. So,
and it's this whole idea of luck versus skill. Of course, they're going to try to say that it was their skill that did it, but we know that it really has more to do with luck when you can catch it right.
That's right.
Lucky, great.
So we stopped the video for a minute or two because my dogs were barking. But we'd like to talk about some of this information on this particular slide. And in particular, how quickly the market recovers after a decline. And people may recall these 3 events: 1998, when the market declined, that was caused in part by the problems of long-term capital, the hedge fund that defaulted. And they had a lot of margin, by the way, which really created a lot of issues with banks and other places. And they were afraid that some banks were actually going to fail because of the margin, I believe, as well. What long-term capital is trying to do is they're trying to take advantage of small mispricings in some obscure bonds, actually. And they actually had some PhD physicists on their staff And even with PhD physicists, they really didn't accurately understand the possibility when they looked at all the statistics that outlying events could occur. They really didn't have a good number on that, and no one really does, by the way. And so that's part of what happened there. But we saw a 14% decline in the worst month of that particular market decline. But look at the recovery. The first month alone was up 6%, and over the next 3 months, the market was up 22%. And again, with the housing crisis, we saw the last month decline, which is February of 09, of about 11%. But the recovery for the first month was over 8%, and the 3 months was 26% almost. And again, with the 2020 pandemic, we saw a similar pattern. And it shows you trying to time the recovery is really perilous. If you miss even the first month, your return is dramatically impacted. So you really I don't know how you can really time these things going forward.
It's so interesting to see when we look at the cash flows. We've talked about this before, how cash flows just evacuate the market at times like this. So I remember in February and April of 2009, how the cash flows were just completely coming out of the market. And then they were sitting there while the market recuperated and rebounded 26% in 3 months.
Yeah. Yeah, and we actually had a client who made us sell out in February of that year, right almost near the bottom of the decline, and we tried to dissuade that person not to sell. And by the time the person, I guess, perceived that the market was recovering, was probably May or June of that year, and they'll never recover that 20 or 25% return that they missed in that recovery. It'll never, that money's never coming back.
That was one client. We actually received a phone call last week from a client who is actually contemplating this. And we actually, we really tried to help them understand what they were doing to themselves by doing this, especially when that we have planned out we have a cash overlay on your overall strategy. We know where you're going to get your cash for the next 6 months, the next year. You don't have to be worried about the market doing these fluctuations and bouncing around. Really, really want to make sure that you're in a portfolio that you can stomach through and stay with the plan, because you don't want to be whipsawed by this type of bouncing back and forth.
That's a great point, Laura.
This chart is just a quick chart. Dalbar is the research firm up in Cambridge, Massachusetts, that provides a whole lot of information. They're completely non-affiliated with anything or anybody, unbiased research. And they've shown over and over again that investors don't perform as well as the stock market when they're investing strictly in just the stock market. And there's a variety of reasons for it. The biggest reason is investor behavior, and it's exactly what we're talking about. It's the buying and selling, trying to time the market when it's a fool's game. So just wanted to point that out to you.
Yes. So here's some lessons. I think that's important for all of us to learn. And by the way, this drives our approach and how we do things. What we do here is based on this information we provided you as well. We're human too, so we need to have proof of how hard it is to time the market ourselves. And we've, of course, taken this information into account over many years. So this isn't just for you, it's for us as well. But most bear markets do last 18 months or less. And Laura brought up a great point earlier that we know what your cash flow needs are. We've spent a lot of time figuring out what your cash flow needs are. And the way you're invested is in part key to your cash flow need and the need for you to be able to survive the average bear market without having to touch your growth assets. And as we said, in many cases, the decline is fast and furious, and that's really what makes it scary. We saw that in 2020. I think that was actually the best example. The market was down about 30% in a month. So it is scary. But the recovery is fast, which is why it's so hard to time. And the returns are very high during the recovery. So really what this means is you got to make two right decisions: when to get out, when to go back in. And trying to hit heads twice, get heads twice when you flip a coin with all of the variables here, it's really hard. So, by the way, also the other aspect is if you have a taxable account, you had embedded gains, suddenly now you're increasing the drag on your portfolio by creating these tax events additionally. So that suddenly you're paying money in tax that should have remained invested and could have been part of your portfolio, and you could have deferred that tax, that tax event to, many years in the future. And so this is actual data from all of our clients combined and the asset classes, year-to-date net returns. And we
before you say anything, Steve, I just want to just really be very, very clear.
Yeah.
We've been talking about the market, the market, the market. Everybody wants to talk about the market. And when you talk about the market, you're talking about the Dow Jones 30 stocks or the S&P 500 stocks. We're in thousands of stocks. We're way outside of anything that you would define as the market. And I think it's really important to remind people about that, because you watch TV and you get really focused on the market, and we're in many markets. Now you can go, Steve.
No, that's a great point. I'm glad you made that point, Laura. And that's what happens. People think, gee, I want to get out of the market. When look at all the asset classes we have as part of our clients' portfolios. And just give an example, what's helping this year in particular are natural resources, which are up 14%. This is, by the way, these numbers are as of the close of the markets on Thursday night. So it doesn't include the, I guess, roughly 2% increase we saw in the S&P yesterday, which is Friday. And so 14% natural resources. And once again, this shows the efficacy of modern portfolio theory and being diversified by asset class. I don't think anyone would have predicted a year and a half ago that natural resources would be providing the return it's providing right now. Also, you can see our alternative assets asset class, which includes hedge fund strategies, and we call it alternative equity also, is only down 3%. Right now, the S&P, as of Thursday night, was down over 9%. So it's down roughly about a third as much. Alternative lending, which includes is a mutual fund backed by private loans, is actually up for the year. Private equity, which is an asset class we've added over the last few months, is actually up, believe it or not, which is really fantastic. And a lot of the other asset classes are not down as much as the market. So this shows you why you need to be diversified by asset class. And I liken it to an 8-cylinder engine. Sometimes, only 2 cylinders are pumping, and that's the case here. But on the other hand, it's reducing the impact in an overall fashion to your portfolio, and it's dampening the decline. As a whole, all of our clients are down about 4% on average. And that ranges, by the way, from the most conservative portfolio to the most aggressive. And even some of our more aggressive portfolios were only down about maybe 4 or 5% before Friday.
And the S&P 500 is down the 4% compared to somewhere over 9%. Yep. And we had quite a lot of folks that have come to us with very heavy laden growth portfolios that we quickly tried to deliver as best we could without creating too many tax problems. Those of you that know, when you come with taxable money, it's always a give and take, the capital gains versus the deleveraging risk. But yes.
We're always really concerned, especially with short-term gains, because, they're treated differently than long-term, of course, from a tax standpoint. And if you're already in a high tax bracket, you could be paying 37% tax on short-term gains, whereas the highest long-term gains bracket is 23.8. So that's a big difference.
Asset allocation works. And as the great Dr. Markovitz has said over and over again, it is the only free lunch. It is the only way of really reducing the risk out of your portfolio. And it's great. It's worked every time that we've had a problem.
Yes. Yep. Okay.
So, again, the allocation, smoothing returns, reducing risk, all based upon the science, where we continue to focus on value. We continue to stay away from those items where we think are create unnecessary risk, distressed companies, companies that haven't really proven themselves. We tend to play in the value area of the investment world, and that's that's the place to be when you're concerned about volatility.
Yes, absolutely. Yep.
So as always, if you have any questions regarding your particular portfolio or you want to discuss this further, as you can see, as I'm sure you know by now, Steve and I love to talk about this. So please feel free to give us a call and let us know what your concerns are, and we're happy to discuss. Thank you, and we'll see you soon.